deal. Oh, here we go.
Yeah, welcome everyone to CRInvestor and LowPro's Trading Psychology Trade the Plan show for Saturday. Where are we here? April 12th, 2014. It's 5 o'clock here on Pacific time. Don't know where it is, what time it is where you are, Landon, but welcome. How are you today?
Hey, I'm good. Good. Just sending out some links here real quick.
Okay. Yeah, and keep in mind, I like the idea of just taking the first 15, 20 minutes or so to get settled in. It's an hour and 2 hour show, so we're in no big hurry. I've sent out a few tweets and those kind of things, so we'll probably see people. Oh, there, and I can tell now we're live on YouTube. So
Yeah, I
I
hear
have
you
that
in
in
the
the
background.
background running just to tell me that we're actually live. So. All right, so needless to say, Bitcoin. Here's my 60-minute big Bitcoin chart over the past week. You can see my show, or if you can see my screen, which it looks like you guys can. Everybody out on YouTube, feel free to PM me on TradingView.com to get the Google Hangout link if you want to come and participate in the room. But as you can see, it was one heck of a wild ride on Bitcoin this past week in particular. There's lots of different. The show and price was up in this neighborhood with a general consensus that trouble was ahead. And sure enough, oh boy, did the market come down here. I think Landon has one or two things to say about this move here, don't you today, Landon?
Oh, wait, I actually cut out for a second. Are you talking about the crash and the rise?
Yeah, basically, just summarizing, I know a lot of our viewers participate in the Bitcoin market, and I was just musing about how we finished our Bitcoin show on, I think it's Wednesdays we do it, with,
Hmm.
generally pretty negative sentiment. And sure enough, she fell apart. And then, ironically enough, here we are on the weekend, and you can argue. Things may develop in the future, but here we are, which is ironic because you remember that this is the 420 level, and the 420 level we had fibber buying on our previous Wednesday show there. So
Oh yeah.
it's funny
I
how we just keep coming back to this level. But anyway, it's been one heck of a wild ride, and I just mused, I guess, out to the audience that you might have one or two things to say about what Bitcoin did over the week and how it affected your trading.
well, geez. I actually usually I do well with crashes, but I completely underestimated the news on this one, and was actually with Flipper, both of us getting caught up at that initial 400 level. And if anybody was watching the price action at the time, it was pretty interesting. I can let me see, pull up my screen share here. Okay, Google Hangouts. There we go. All right, there we go. We got Bitfinex pulled up here. Yeah, the the price action sure threw me for a loop. That's for sure. We'd came down, and I actually ended up I believe buying in right here at that initial 406 level, and where that and initially at that time we had a ton of support. I'd done pretty well up to that point. I'll have to go back again, and had 460 shorted. Of course, I made the mistake. I didn't stick to my plan like I should have, and I ended up closing early around 440, right before the initial dump, and then jumping in where I thought was quite a wise move around the the 406, 407 level, right above all of that $400 support. And as everybody witnessed during the time, that's when we had a quite incredible market crash, all the way down to 384, leaving a lot of people at the time believing, okay, well, the worst was over. Of course, if you track that as a measured move across from that 455 level, or I guess you could say more along the 440 level, where it closed that short, um, all the way to that 480 level, where we had that initial tank. After the failure to really break through that 400 prior 400 support that then turned resistance, we then had another downturn, which if you set that up as a measured move, put us right down in the 340, 350 levels, where me and Flipper ended up buying around the 350 levels ourselves. But then, of course, also didn't stick to my plan and ended up getting out of that trade way too soon myself. So, but as you can see, we've rebounded quite significantly up to the 420 levels and topping out here around the 439, 440 levels. So, and the rest is current price action. So.
So did you tell me about your emotional state going through that entire roller coaster?
Oh geez, it was horrible. I normally have I normally have my head on straight. That's one of my best trading attributes. Is I can keep my emotional cool when everybody else is freaking out, and I think I think what set me off balance with the whole thing is the first breaking of the trade setup from that 460 level, which was perfect, absolutely perfect, and then veering off course there. So boom, there was the first mistake, and of course on the psychological level, that mistake just resonates in your head, and so at that time, seeing all of that profit, breaking my own rules, breaking my own plan, seeing all that profit I had missed out on, you then open yourself up to, of course, more risk. You want to win that back. You're like, hey, I should that profit should be mine. So, so of course, then you make the second mistake of getting in a position that didn't really have a confirmation yet. That 406 position, even though it looked oversold. All the parameters were there, but there was never any confirmation that that was it. That was the bottom at
What
that
does
point.
confirmation look like to you? What do you mean by confirmation?
Well, basically, higher volumes on bullish action, higher highs, higher lows. Basically, we had just flatlined at that level. There were uh, really not very many, even though it was looked oversold. There were really no bullish indicators in there at all either, um, and most of it was just held up through that psychological $400 mark that everybody had been talking about. So of course it would have been thinking back, in hindsight, quite easily
You
for somebody to make a big sell there and kill it.
Did you have any stops working? Do you work with stops?
No, just manual stops because I usually the only time I'll put in a stop is when I'm asleep or away from the computer, but for the most part I'm actively trading. I've got it in my peripherals at some point. I'll pull it up, check it, every so often. So
So just a question would be, how often do you put on trades where the market goes against your position, and what's your sort of methodology to basically admitting you were wrong about the decision and when to get out?
Well, that's basically it's similar to you. I mean, right within the trade setup. As far as how I've been trading, I usually, I'll usually have a good 1 to 3, or two to
Well, I don't
three
necessarily mean
ratio
that.
on.
I mean,
Oh, okay.
I understand your risk strategy. I
Yeah.
guess the question is if you don't use stops, like when I trade, I have to use stops.
Yeah.
And if you don't use stops, then you can get into sort of this, a level is breached. And, I mean, I can understand buying where you bought there.
Hmm.
But I think mentally you just had to have a level that if this level's gone, then I just have to admit that I'm wrong and get out. And that's the good part about stops is that basically it makes that decision for you very quickly.
Well,
Um,
I'll make a mental stop. I'll have a price in mind to get out and a price in mind to exit. The problem with that particular trade is being emotionally caught up in the failure to stick to the prior trade. I didn't make a trade setup, a trade plan for that particular move. It was quite literally I got a good price here, jump in, action. Um,
would you consider this more of like a revenge trade?
yeah, yeah, definitely, definitely.
Yeah,
Oh,
that's a
and it
very
didn't
typical.
stop there.
That's a very typical uh, trap.
Oh yeah. Well, and it didn't stop there either because um, I ended up getting into some with all the high volatility, some good small positions that ended up putting me in profit. And then several times I actually, I would have had a loss here, but then I would have won that back there. But the biggest problem for the whole thing is I kept setting myself up for being emotionally off. And by doing so, I kept making mistakes that I normally wouldn't do. So so say coming down to that 340 level, that 350 level, there were plenty of opportunities in there to and pick bottoms if you weren't actually setting up a plan. And me and Flipper were actually on both ends of that, trying to pick bottoms the whole way down, which is you know it, and that's one of my things that I always tell people. Um, you know, anytime you're looking to catch a knife, it usually results in blood. And that's exactly what had happened. Not to say that you don't want to have a plan and a area to buy in and execute in, and not that you don't want to look for confirmations at a lower price or an oversold price, but when you're trying to pick bottoms and having to constantly move that back and forth and catch the knife, and not actually building a plan, and just moving with the price action, it's so easy to get burned once after twice after three times, over and over and over, especially during a crash. Um, and another big part of it too, I hadn't gotten any sleep throughout this whole thing. I used to flip price action down through a crash all the time when things would happen, but I was finding myself during this crash with all that volume trading with a pretty large amount and sitting there and just being really lazy on the trigger for even for my scalping trades, which were all screwed up. And then finally, when we had gotten that confirmation in, after making so many traditional screw ups, after going away from my plan, away from my rules and my strategy, guess what happens to your psychological mental state? You might have the right buying price. You might have, boom, finally made it. You finally got it, exactly where you needed to buy in. And guess what happens? You end up selling it too quickly because because
Yeah,
you've been so traumatized from the prior price
yeah. Well,
action.
so this past week,
Does that
I
make
mean,
sense?
I was joking with you earlier. Um, these are pretty trying times for people in Bitcoin land. We're in a bear market, and there's an old cliche that says, in bull markets, everyone makes money, and bear markets, no one makes money. So, just that simple fact.
That's actually something I've wrote out one time that I have a saying: bull markets take care of themselves and are loved by investors, but bear markets are a trader's fancy.
Yeah. Um, we have a very wide trading range, and I mean that's the irony of it all, is that if you just blow up this recent price action, uh, this is some pretty volatile stuff. Like, it'd be interesting to see what the ATR is, or average true range. But just this day alone here, high 435 and a low of 340. So,
Yeah.
from 435, we're starting to talk about, the better part of 20% move in the asset price in one day.
Yeah.
So, this is it's not for the faint of heart. That's for sure.
Hmm.
And I guess lucky there isn't any Bitcoin futures. But you were telling me that there are some people that are playing these things with leverage positions.
Oh, I play it with leverage positions. That's all my trading.
Yeah. So that means that every penny movement isn't just one penny; it's multiple pennies.
Hmm.
So you get
Two
even
point
just
five
like
pennies for me.
a $50 swing here. Um, that can represent some serious money.
Hmm. Oh, and yeah. In fact, I throughout that whole ordeal, um, I normally I would have made a ton of money from this whole thing, and instead, over the course of 3 days, I was lucky to break even. I really was.
But what do you
But
think the difference was?
oh, what do you mean the difference?
Well, why was this time different?
Oh, well, that basically going off the plan, becoming emotional, and then not making a new plan.
So, do
Falling into
you
the
do you
same
think you're
traps.
back on plan?
Oh, I had to step away for a little bit.
Well, that's good.
Um,
So that speaks to your self-regulation. So that's good.
but and because it's the plan is not just plan or a trade setup. It's not just about controlling your destiny in the market or having the perfect ratio, but it's also controlling you and setting you up for the correct mental state and the correct processes. Because as humans make crappy traders. But anyway, you there? I'm breaking up, cutting out.
Yeah, sorry about that. It's my connection's a bit splotchy. Bear with me
Oh,
here.
oh, mine too. So I was worried that that might have been me.
Sorry about that. So, piece of advice, because these shows have, sometimes we do have connections issues. Probably not the best thing to go. Are you there?
Yeah, yeah.
Just carry the conversation until I can come back.
No, no, I've got the same thing going on over here.
Okay.
I gotta get a new card, a wireless
Yeah, and
card.
I think that's probably a good segue here. Um, it's now about 25 after or 20 after 5. I do see someone has popped into the Google Hangout with us, so welcome, Eric. For
Speaking
anybody
of
who's
which,
watching on the YouTube, you're more than welcome to grab the Google Hangout address and join us. If you have any questions, Eric, feel free to post them.
everyone
Um,
seems to be gone on TV, so
I beg your
uh,
pardon?
said everyone seems to be gone today on TradingView. It's kind of odd. I would have
Well, but
had
see,
more people
the
over.
interesting thing there, right, is I bet there's a lot of people that are very exhausted after this past week.
Oh yeah,
Maybe they're
I'm exhausted.
Maybe their physical capital might be exhausted, but I would imagine quite a bit of mental capital as well.
Mm, yeah, definitely. I don't do this full time. I work a full time job and then do this as a side job, and and sometimes just like a regular trader, I'll be up. I get up 6 o'clock in the morning. Sometimes I'll be up till 6 at night, or not 6 at night. Two in the morning. Yeah, yeah. Basically, I'll only get about 4 to 6 hours of sleep sometimes. If there's a lot of interesting price action. So
What's Hobie doing?
yeah. What's going on? And that's a horrible thing for me. Where considering where I live, in Central Time in the States, is uh, is basically the best time to trade is usually from net almost now, I'd say, to about when China goes to sleep, which takes up a good normal 8 hours of sleeping time for most people in my time zone. So it can be a little rough sometimes.
Well, that's an interesting commentary in itself,
Hmm.
because we used to always consider the Asian session to be sort of the institutional quiet period,
Yeah.
and now that China has basically emerged as this economic superpower within its region, you can slowly see the shift of capital moving.
Yeah.
So now
Oh.
we in North America are gonna, because everybody else in the world used to set their watch based on what North America's doing.
Mhm.
And what I see now is we're now having to set our watch on what Asia's doing.
That's taken a lot and place a lot in all the traditional markets. I've heard of a lot of traders that a lot of professional traders out there, or guys with hedge funds that they'll work with in the European markets, the American markets, and then off to Asia. After that, in the afternoon for them. So it's just it is not a 9 to 5 job being a trader. That's for sure.
Well, also keep in mind too that this Bitcoin is, in my opinion, it's not very classical investing style.
Yeah.
And the Chinese are notorious for loving to gamble.
Hmm.
I would argue that this Bitcoin is a bit of a gamble.
Yeah.
I mean, we on the outside, we don't even look at the internal stock market within China, but man, some of their stocks internally, they're just gone crazy. So this is par for the course for them. So
Oh yeah.
anyway, all right. So just to sort of dovetail into our conversation topic today, let's make sure that you can see my screen here. Yep. All right. So this Google Documents folder here is open to the public. Um, I've posted the share links in the lounge. If you would like to, if you'd like access to them, feel free
Hmm.
to pop into the Google Docs. Basically the show today. The general theme that we like to talk about in these shows is risk management, trading plans, setting yourself up for success, all those kind of fun things. I like to take the first sort of half hour and just sort of slowly slide into the program.
As for me, common mistakes.
Yeah, well, and that also talks a little bit about that dovetails into what you're going to be talking about today.
Yeah.
Um, my presentation today, last week, I talked a lot about I'm going to constantly reiterate my 2 rules of investing through these shows. So last week I spent a lot of time talking about rule number 2, which is risk management. And today I thought I'd talk a little bit about rule number 1. So that's what I will be focusing on my presentation, a couple strategies that I use.
Hmm.
From what I understand, LowPro here is going to talk a bit about trading mistakes
Hmm.
and those kind of things, and how you can deal with mistakes in your trading plan. And from what I understand, I think you handled yourself pretty professionally in that you didn't speed up and tried to do a whole bunch of more trades. It sounds like you slowed things down a little bit. So hopefully that's good, but it sounds too also like you sort of managed your way out of the problem.
Yeah, I had to do it step by step in little pieces that I knew how to do because because my emotional state was washed. Sometimes that's all you got.
Yep, okay. So onward we go. Um, my presentation today is just gonna, well, specifically, as I said, we're gonna talk about 4 or 5 different things. Um, we're gonna start off with just a simple review of the 2 rules of investing. As I said, I really like to drive those home. I would like to take a little bit of time to talk a little bit about average winners versus average losers, versus expecting a certain win percentage. That's actually a bit of a trap. As I said in my presentation, I'm going to talk primarily about rule number 1 today. And I'm going to just outline for the show how, by following my trading plan and creating very specific requirements around trade setups,
Hmm.
how I can take 2 very specific trading models that will meet those setups and apply them on a daily basis. Once we sort of reviewed those 2 simple setups, then we'll just finish off my presentation with a quick look at my weekly commodity trend survey, and you'll literally see the setups in motion. So, all right, so as I'm sure viewers are well aware, I run a website, therationalinvestor.ca, of which at any given point in time, you're more than welcome to visit. World of information. And as you saw me just do, I have a number of public seminars that I've given over the years. I used to give these to the public when I was an investment advisor, broker trying to drum up business. And recently I was asked to write a course basically on how to invest. And so that's what this 72-page document, which you can access just by clicking this link here. It's totally free. Somebody the other day asked me, Brian, why are you giving this away for free? And I'm like, I don't know. So it's there for free. Take advantage of it while it is. Please don't be bad karma and copy it. That would really suck. All right. So, as my sort of bullet point outlined for my presentation, where's that? Here, around here somewhere. There it is. First thing I want to talk about is 2 rules of investing. So, rule number 1, and it's just right in my introduction. Basically, start off with a bang. I give you the most important information on the first page of the course. Problem is, most people don't realize how important it is, and they often end up disregarding it. But anyway, the 2 rules, very specifically, rule number 1, come up with an algorithmic approach to your investment decisions. So kind of like Landon, why did he want to get into these trades? And what I found interesting was he told me that as soon as emotions started to come into the equation, actually his algorithm started to break down, and he started to make decisions that were not based on past empirical evidence that supported the notion for the trade setup. They were based more on anger at the market, fear of missing out, and revenge. So very, very important that whenever we think about pulling the trigger, we have an algorithmic reason why we're doing this. And that process from start to finish has to produce results 66% of the time. And 66, really simply put, is 2/3, right? So 2 out of the 3 times you swing the bat, you should feel comfortable that an outcome that is beneficial to you should happen. Now, here the interesting thing, we're going to talk later about winners, your average winners being bigger than your average losers. And the simple fact of the matter is you may have a statistical model that is 66% accurate, but this is reality that we live in, right? And no matter how wonderful statistical models are, you're going to run into pockets of quote-unquote anomalies. And how you handle those pockets, maybe you have 2 or 3 or 4 losses in a row. That's really going to define your longevity as a trader. So regardless, rule number 1 basically says 66% of the time when you pull the trigger, you have pretty good confidence in the outcome that you expect. And rule number 2, and this is really just a function of, keeping yourself in the game, and it comes from the boys in Vegas who developed these rules as gamblers for a living, who actually gamble for a living. Never risk more than 5% of your stake on any one single investment idea. And I even put in there are many different ways to manage that risk, but it really shouldn't breach 5% of your stake. And what I find fascinating about this experience is that a lot of people will look at those rules and they'll be like, oh, no, I don't do that. No way, man. I'm balls to the walls. But the irony of it all is that when you actually dig deeper, and the guys who actually can survive, they do follow these rules. You can go 100% in or even go more than that. But the key is, what's the risk if the trade goes against you? And that's where that 5% rule really pays off. Because, let's face it, none of us are 100% accurate. And the irony of it all is that quite often when we're feeling really good and really positive and we're just kicking the market's butt, that ironically enough is when we're most vulnerable. Because that's usually when the losses pop up. So if you can try and stick to the 2 rules, they always keep you in the game. You're always at the table. Yes, you can handle taking losses. But ultimately, over time, because of your belief in your statistical model and the homework that you've done, your setups, if you will, that you will come out ahead. And it's just a long, slow process of grinding the statistical model out. That's basically a trader's life. All right, so that touches on the 2 rules. Just going to take a minute or 2 and just talk a little bit about making sure that your average winner is bigger than your average loser. So what do we mean by that? What I found, and this is even from my own personal trading experience, is number 1, people are really obsessed with having indicators or systems that are, extremely highly accurate, and they can tweak an indicator and set it up so that on any particular market looking backwards, it spits up phenomenal results, and you're just like, you always do this, you always make money. And that's an extremely dangerous trap to get into in the stock market or any kind of market, any trading really for that matter.
In fact, most of those guys are just trying to sell you stuff.
Yeah,
and that's really all they're doing.
I mean, the simple fact of the matter is, I found just from personal experience, is that when you start actually getting to the point of saying, I know that this is going to happen, then your opinion is actually entering the trade. And keep in mind that the market is designed to feed into those human emotions. So quite often I see markets set themselves up to elicit a very typical human reaction. And ironically enough, those are often traps. So this sort of general notion that if you can make sure that your average winning trade is bigger than your average losing trade, then at least if you go through a period of time where you take some losses, the statistical, if you just crunch the numbers on a spreadsheet, as long as your average winner is bigger than your average loser, you can actually be wrong up to 50% of the time and still make money. But this is far, far easier said than done.
In fact, most professionals are wrong 50% of the time.
Well, and so that's the key, right? Is that the boys on the floor, and so what we have to understand is number one, and this is a big part of the human experience, is we literally have to let go of the egotistical attachment to a trade. And that's very hard to do. And I found, and I often joke with my trading partners, I joke and I'm completely dead serious. The best trading I have ever done is when I turned myself into a robot. And I literally, it was the company that I work with in Chicago. They have these sort of little tryout periods. They call them combines. And, if you know football tryouts in the States, that's a very popular term to try out for professional football. They have these combines. Anyway, long and short of it is when I let go and I basically let the model take over and I didn't attach human emotion to the trades, the actual trade process, my percentage winning went through the roof. And actually, one particular combine, I so impressed them because I had like a 95% win rate, and the only way I could achieve that was by basically being very systematic in my trading approach, and not getting suckered into the typical human emotion. So, anyway, so just to finish off that thought. If you can try and ensure that your average winning trade is bigger than your average losing trade, then even if you go through periods of, maybe 3, 4, 5 trades in a row losing, and hey, as traders, we all go through those periods, you can still come out ahead statistically at the end of the day. It's a lot easier said than done. But if you can try and work that into your trading mentality, your approach, it actually makes the whole game much, much easier over the long run.
In fact, making 2 or 3 bad trades in a row is usually the result of not having that plan and then trading on emotion.
Right. Well, see, and we will see shortly that actually waiting patiently for these situations where your reward is actually going to be bigger than the risk that you're going to take, if you just have to patiently wait for those setups, you take far fewer trades.
Oh yeah, it's the great Jesse Livermore quote saying, "Don't give me timing, give me time."
Right, and I've heard you talk about that before, right?
Mm-hmm.
And I've found in my personal trading experience that now some like this past week I got lucky. I jumped a setup a little bit early, and it turns out the charts confirmed my sort of intuition, and the trade worked nicely. But the irony of it all is that, ironically enough, if the trade is a good trade setup, it will set itself up. The charts will tell you, oh, look it's time to buy, and the market will literally give you a window. I was watching crude oil this past week, and I actually literally watched a Gartley pattern come in. I don't know whether you know what that is.
Mm-hmm.
For all those out in internet land, I'll just Google Gartley. In fact, it was we'll even be more specific. It was a bearish Gartley. So it looks something along these lines. I don't know whether you can see that very well or not. See if you guys can see my screen. Yeah. I literally watched this pattern come in and it hit point D and the market just sat there for literally about, I would even say maybe 2 or 3 minutes. The market literally just sat there and just said, here I am. I'm ready to be shorted. Here I am. Just sitting there right at that point D. I can show you specifically on the chart. Let's see if I can find it. Really interesting. And I was sitting there mulling it over, going, "Do I pull the trigger? Should I go for it? Should I go for it?" It wasn't actually in my trading plan. This specific plan I'm running right now. So as a result, I didn't take it. But man, it turned out it was just an awesome trade. And isn't that always the case? Let's see if I can find it. Where are you, Gardley? Gardley. Yeah, it was right here. So the Gardley basically, it says, let would go back to that image that we just had on the screen. Where was that? Right here. So here's what the Gardley looks like. So big move from X to A down, then a rally back to the 61.8, then 38.2 at least retracement, and then up 127. And this level here is actually the 78.6. So just remember the 61.8 and the 78.6. So, and actually this is totally off topic to what I wanted to present today, but I just want to show you this. It's quite remarkable. So market started here, went down to here. So there's our 61.8. Actually, maybe this is a bit off. Interesting. On the crude futures themselves, actually, this was a perfect 61.8. But anyway, so the Gardley goes like this. It goes boom. Whoops, try that again. Boom, all the way down here. Then up 61.8. Then 32.8 up to 88.6. Then up to 78. And it just sat here, right at this level, and just said, short me, short me, short me. Perfect Gartley pattern, and sure enough, boom, nice down move. So anyway, I don't know where I was going with that. It was really interesting setup. But it just, I find that the market actually, if you're just patient and you just wait for it, just wait for it, just wait for it, it comes in. All right, so specifically today, and actually I gave you 3 setups today, but we didn't do the Gartley too much. Specifically today, I wanted to talk about 2 specific trade setups that I use on a regular basis, how they meet my 66% accuracy rule, and then how the trades themselves are designed to meet this make sure your average winner is bigger than your average loser criteria. So trade setup 1 that I wanted to talk about today was the harmonic pattern that I find happens quite often in the market, and unfortunately I'm going to have to close this window to open up. Where did it go? YouTube presentation. All right. So this is the first. Hopefully you all can see my screen. Good. So this is the first setup we're going to talk about today, and it's called the bullish or bearish ABCD harmonic price pattern. And it's just basically based on the belief that price doesn't actually move from point A to point B. It actually moves in a 4-point pattern. A, B is an initial first burst and a first leg. B, C is a natural correction of that first leg. And then C, D is ultimate. Is the ultimate target of this entire move. So Andre A just typed in, Brian, why do you do so much noob-friendly shows? I want to see some intermediate ideas. Well, I'm sorry, Andre. I mean, this is basically what I use in the market every single day to make money.
It,
So,
the
if
noob
this is noob,
related stuff is the best related stuff. That's
pardon
why.
me?
I said the easy the basic fundamental stuff is the best stuff, really. And
Well, the old adage, right? If it ain't broke, don't fix it.
yeah,
If this works, if I go into the market and I use this on a daily basis to make money, then what the this is what I do. And by all means, Andre, if this is getting boring for you, I'm certainly not handcuffing you to participating. Um, so, that's an interesting point in that, maybe people will actually find what I talk about to be redundant and kind of novice. And if you ultimately get to that point, then that's great. And that means that you have tools to go out and make money on a daily basis, and all the power to you. So that's totally cool. All right, so finishing off my Bulls ABCD harmonic price pattern. As we said, this is basically a continuation pattern where really what we're looking for is point A to point D. On my Twitter feed, and you're more than welcome to look at this. It's in all my feeds and all my Google Docs and all that kind of fun stuff. So you're more than welcome to look at this at your leisure. But if we actually take a look at what does this thing actually look like in practice, here is an example, and this is off a 3-minute chart from this is September 2013 futures contract. But this is basically the bull ABCD price pattern at work in crude oil, making me money on a daily basis. So, how does the bot work? So, A to B is our initial move. And in this example, that's from about 106.40 or wherever that is, 106.50. Up to 106.99. So, a nice 50-cent move. The pullback from B to C is that 99 level back to the 67, 68 level, whatever that is. And then ultimately my target is point D way over on the right hand side of the chart. So how do you play this? Very simply put, you want to get some sort of technical setup right along distance from C to D, and I break that into quarters. And I say, if I take a position at 1/4 of this move, and it goes the entire distance to point D, from C to D I'm talking about, then in essence, if I risk to that point C, or one tick below that level, then I have, by definition, a 3-to-1 risk-reward setup. And so when I'm looking at any market at any given point in time, I'm constantly looking for that 3-to-1 setup. So, for example, on Friday, and keep in mind, I trade this every single day in crude oil for profit. So it's not like I'm just doing this for the love of twiddling my thumbs. But, Friday's an example where I patiently waited. Really, always, whenever you, I don't know, did I cut out there? How are you? Can you guys still hear me?
yeah, I can now.
Back? I just noticed. Okay, so I apologize. Things, cut in and out. So anyway, so finishing off this bullish A, B, C, D price pattern. Let's see if I can load a clean chart now. Let's see what happens. All right, so let's see if I can find that setup here again. Where were we? I'm gonna have to zoom out a bit. And you're more than welcome to go look at the setup information at your leisure. All right, so it was right here. A few things that I'd like to see, and sort of maybe this is speaking to your intermediate technical analysis, Andre. But for the bullish blot to set up, I need to see first a double bottom come in. So this kind of price action here, basically where we have a low and then another low and then a high. So basically this is talking to market structure. So I need to see this kind of price action come in to set up the bullish bot. So I suppose as technicians, we would simply say, we've had a nice down move. What's a logical bounce point? So when I start to see the double bottoms come in, then I can start thinking about, okay, maybe we're going to get a rally scenario here. Specifically, for me, because I'm a crude oil trader, a prop trader, I have to wait for the retail market to open up. So the retail market opened up, where are we here? Oh, I bet you this is the wrong time zone. Yep, I have to reset that. All right, so retail market opens up. The pit opens at 6 o'clock. So boom, there's the pit open. I can't really participate prior, so I had to wait for the pit open. We had this double bottom working. So basically, I'm from this point on, from when this point here is broken, I'm hunting bots. So the first criteria of hunting bots is I have to see a correction off of a primary move of 33 to 66%. So if it falls within that 33 to 66%, then I can consider a bot setup. This pullback here went to 78.6, so I cannot consider that a bot setup. I have to just sit and wait patiently. When's the next bot setup going to come in? And like I said, on TradingView, I happen to have a nice little bot setup predefined. So there's the 33 level, there's the 66. So all I'll do, I see the double bottom come in, and all I'll do is just, okay, the next move. All right, we got a pullback, maybe potential bot, maybe potential bot. Uh-oh, we went too much. So this can't be it. And then we get another rally. So then we do the same thing, all right? There's the bottom of the move. Here's the top of the move. Got to see a 33 to 66% setup. So here's 33, and it stopped. So hello, we've got a potential bot setup. So, a lot of my people, I say, all right, the bot has come alive. We've got, number one, a double bottom, suggesting market structure has turned bullish. Number two, we still have upside targets. Here's the old high. If you believe this is a bottom and you're playing OTEs, and this buy level was an OTE, then your target has to be the old high. So, even old highs, that's got a realistic shot to work. Now, here's where the magic of the bot comes in. If I believe that this is a bullish pattern, then if this is a bull ABCD, you can visually already see where this stuff is going to form. So there's the A to B, that initial leg, and here's the C to D. So in essence, if this is a continuation pattern, we've got a very realistic shot of seeing this level right here. Now, how are you going to play that? Well, again, this is the magic of the bot. We know that this is the initial move, so let's draw a point where this is 100% and this is 0, right? So we basically duplicate that range. And now let's project this second fib off of the next low, where we propose this is where the bull ABCD target's going to start. All right, so, according to our classic diagram, let's make sure everybody can see this. Good. Basically, the harmonic pattern is A, B, C, D. If we look back to our chart, we see that it basically looks like this. A, B, C, D. Now, I'm not for a moment saying that the market is going to stop at point D here. And I'm not going to say that the D point is actually like a shorting level. Quite often it does work out that way. But the point here is that I'm constantly through my trading day looking for tradable setups. Where is something that I can find that I have a pretty good confidence that if I take it 66% of the time, it's going to work out, and the trade itself has a built-in 3-to-1 risk-reward ratio, so that if I do take this trade, the odds of me making more money than if I lose and this trade goes against me, I meet that make sure average winners are bigger than average losers. So, looking at this trade, the bought long entry was off of 103.07 or 37. Right in there. Now, what's fascinating, I was speaking earlier to Landon about this.
Yep.
Was that, you could have taken this trade here, right? There was a fractal low there, and you could have gotten in here.
Mm-hmm.
Just been like, oh, God, please don't hit my stop, don't hit my stop, don't hit my stop, blah, blah, blah. But what's really interesting is if you were just patient, the market gave you several opportunities. And then if we're speaking to, I want to say Andre, but I know his name. I even wrote your name down the other day. Magnus. Magnus wants more advanced stuff. Give me more advanced studies.
Let's bring it.
You could argue that if you were just nice and patient, look at what developed here using the more advanced studies. Look at what developed right off of this setup. So there's our A, and right now we don't know where the price is going to go. So A, B, C, here's the 25% level, right? So if we have an idea, okay, we've got a price model in mind, then it looks like we have a realistic harmonic pattern. How are we going to trade this? Well, if we break this into quarters, then 25% is 103.37, and look at what develops. First we'll look at the MACD. If you can find, and this is for anybody who wants that technical analysis for intermediates and they don't figure that they're a noob anymore, if you can get your momentum indicators to start confirming the price action off of these bought levels, the signals are huge. So off of my MACD, this is the raw momentum indicator. If you bought here, meh, no real big deal. Here, meh, meh, meh. Hello, double bottom on the MACD indicator is a huge momentum signal, and what a coincidence, it's right off this 25 level. So, in essence, the price action sets up the trade. There's the trade setup, and now momentum is coming in and confirming. Now, if we look at our Willie, again, this is just sort of raw momentum. The line, there's the double bottom with the moving average cross, and I would call this an up thrust move, where you actually have the moving average is moving down to sideways, and the indicator itself punches through, which means you can see that Willie doesn't actually get officially overbought until way over here. So whenever you get these up thrust moves, you got a little bit of a window where basically it's just free sailing, and so that's what I think happened here.
All right, I like how you with that MACD setup that it also listed for that measured move, the confirmation after there was essentially much less bearish divergence on there than the prior move.
That's right. Well, see, the interesting thing is if you look at momentum, right, the market actually bottomed, and this is why, I like trading crude, is, we were actually making lower lows here, right? But if you look at momentum, it was really petering out, and then we actually stopped making lower lows and we started making higher highs. Now, we got a bit washed out here, but in essence, we just, whenever you get these really tight little double bottoms and tight little double tops, they're great confirmation of levels. So we happen to have a level that's set up here, right? We had this harmonic pattern. If you can get the momentum indicator to fire off a buy signal at one of these levels, that's huge. And the interesting thing is, the trade setup, all the mechanics were there for this to work. And yeah, I made $160 trading one contract. And if you just look at the trade setup, my rules are at the 50% level, we move our stop to break even. So on this one bar, we pushed up, we hit the 50% level, and on the same bar, we hit the 66 level, and at this 66 level, I have a rule that basically says, okay, now I have to start moving a trailing stop. In other words, moving my stop up to start locking in profits. You'll notice that this bar actually opened up, it moved higher, and it left like a low here 2 ticks below this bar's high. And as soon as it punctured that, I just got out because I didn't want to, And this is the interesting thing about being a trader, on a sim versus trading actual money. I was up 100, like this was 37. We're sitting here at 56. I'm up $190 in less than what? I put the trade on here off of this reversal. The actual MACD signal came in here. You still could have gotten filled down here. And this trade happened, the actual move happened in maybe 60 seconds. I mean, it was very, very fast. So, like I'm up $200 and I'm just like, you know what? Just book it, book it, book it. I got a fat finger fill, right? So I didn't get filled to like 54 or 53. And so I ended up walking away with like 16 ticks, I think. So, that speaks interestingly to...
I just realized that was 3-minute crude oil.
Yeah, this is a 3-minute chart. This is pretty fast stuff. What's fascinating is that, had I just been a little bit more patient, right, and, I do sort of have a tentative rule, and I think I'm going to make it a little more hard concrete, that I have to wait 10 minutes after this stop to trail level is hit before I can actually start moving my stops up. Because had I just moved my stop up to this low here and left it, then my AOC target up at 103.71 would have been comfortably filled, eh? So, this is basically a trader using a harmonic price pattern on a daily basis to make money trading crude oil. So, I don't care if you consider this beginner or intermediate or advanced. This is direct application of these models on a daily basis, trading for profit.
And I'm a big believer in the keep it simple, stupid.
Yeah,
aspect of trading as it is
you
anyway.
know, yeah. In fact, a lot of my guys would say just turn these indicators off. Just say, you know what? Don't even look at the indicators. Everything you need to know is
Yeah.
contained in price action here. The fact that we had the double bottom, which confirmed market structure, we had higher highs and higher lows. We had the bot setup that came into the statistical range, right? At least 33, but no more than 66. This previous setup didn't break it, so you had to just keep being patient. And the irony of all, like I even commented with others, is that if you could get to the point where you're doing trading multiple contracts, then on one contract, on half the order, you work these really strict orders, but on the second contract, you just leave the stop at break even. And the runner, the first contract you may have gotten out here, although, if you were a really good trader, you probably would have run it to the point D. But on the second contract, who knows where the hell you would have got out. Maybe get out up top here. And this is where, the real professionals trading crude oil make the big bucks. It's not so much on the one lots, it's on the runners, right? So this runner here, it almost made $1,000.
Oh,
And that's just using a simple moving average system to sell.
hey Brian, Andre says check out the tool right below fib retracement called trend-based fib extension. It's very handy. And he also said he means talking about more in depth instead of uh, indicator stuff. But like I guess what do you mean? Like more of the reasons why this or that? I don't know. But yeah, yeah.
Right. That's
Why? Ah,
pretty.
there we go.
Yeah.
Yeah. Why
I mean, keep in
AB
mind that.
equals CD works.
Pardon me.
Stuff like why AB equals CD works. Which yeah, good question.
Well, here's the thing, right? Is you're asking me to tell you why the universe works a certain way. I don't know. It just does. I mean, you can Google harmonics and price patterns, and spend the next 2 weeks just reading crap about why harmonic price patterns work the way they do. I don't think anybody really knows the exact answer. I don't even know if there is an exact answer of why it works. If anything, as a trader, all I'm looking for is an edge, right? This is my edge. Again, getting back to my 2 rules of investing, I used to tell people, I don't care if you get your signals from your dog food, your dog's dog food. If the dog food lands on the floor a certain way, that's a buy signal. The dog food lands on the floor a certain way, that's a sell signal. I don't care what the signal is, as long as it's right 66% of the time. That's all I care about. There's people that I work with that get their signals from the stars. They literally, planetary formations dictate what they do in the marketplace.
They probably don't make much money.
They make a shitload of money. It's stupid how much money they make. So, yeah, I would definitely say there is a lot of money to be made in planetary cycles, but that's another conversation. In fact, I should have them. They're really interesting guys, and they give a lot of information away for free. Let's see if I can find them. Foundation of Cycles, I think it's called. Foundation for the Study of Cycles. Yeah. So if you want to learn how people trade using cycles, this is this Edward Dewey. Trust me, this is very powerful stuff. So you want to learn how people trade that way. There's a link to learn up all about that stuff. Anyway, so the specific answer as to why this happens, I cannot speak to that. but it does, and you're more than welcome. Like me and my silly little Googles, we'll just A B equals CD harmonic pattern.
Well, like you said earlier, nothing really trades in a single A B. Well, typically does not trade in a single A B just straight line. I mean, there's always going to be people that are going to take profit beforehand, and usually that's at that point at which maybe let's say um, resistance comes into play for a particular pattern. Might be where the majority of those individuals ended up taking profit, and backtracking price is where you come in with your B pattern on, say, like a bullish AB equals CD pattern. And then of course, if the entire movement is strong enough altogether, then that's why you have the B and the C part, that pullback that um, uh, within the price is you have those guys essentially betting against breaking the resistance for that particular point. However, that particular movement altogether is actually going against them, as it is more bullish or more stronger than that particular resistance. Whereas then you have a measured move equal to the amount that that move just took place, and many times even much greater, as you saw with that price action on oil, right, Brian?
Yeah, I mean,
I would
at
say that
any
would be
given
a
point in
big
time,
reason.
at any given point in time, you always have to ask yourself, what are the higher time frames doing? And in this case, I think we were working a higher time frame target. And as well, keep in mind this was Options Friday. I did a big write up on why I thought prices were being moved to a certain way, where they were. It turns out there was lots and lots of incentive for them to, I think this was options expiry right here. So, and there was a very significant strike price on the oil ETF right at this level here. There are lots and lots and lots of calls just at this level, and just a few puts, and they closed it just below the strike price, so all those calls expired worthless. So to me, I think there was something bigger going on here. Having said that, what I'm looking for as a trader is I want to find these edge setups, right? Where I know historically I've got a 66% chance of that point D being hit versus that point C being hit. How I manage the trade along, that's a whole other conversation, but that's my edge. That's constantly what I'm looking for. The second, I think I'll probably leave it at that for the bot. And by all means, if you have more questions, feel free to ask. The presentation I had today was I also wanted to take a quick look at the second model that I use. I don't use this as much in my day trading as I use it in my sort of overall market analysis. Having said that, if it meets the 2-to-1 risk-reward ratio setup, then I am very interested in taking the setup. So the bot, as we said, it has a 3-to-1 risk-reward ratio. So that's why I really like it, because basically when you can find bot trades, you basically have a situation where the odds of you making money are very, very highly in your favor. All right, so the second setup that I mentioned there was the 50% rule. And actually, on my screen here, I don't know how we can, I don't know whether you can zoom in on this or not. What happens if I go like this? Does that change? Okay, well, that's a little bigger. All right, so when I first started to trade, this was actually And I'm sorry, I'm just reading Eric B's question here. As soon as I'm done my presentation, Eric, I'll be more than happy to read up on the questions and I'll try and answer them. All right, so on the screen right now is a very simple rule, and actually Fibber was brought this back to my attention. I sort of let it slide, but it turns out that I actually use the 50% rule quite a bit. I learned the markets, actually the very first thing that I learned about technical analysis was the concept of double tops and double bottoms and the 50% rule. The 50% rule actually was really handy back in the days before computers and calculators, because you could calculate it fairly easily in your head, whereas trying to calculate a 61.8 off of any kind of move, no matter what the numbers are, is challenging at best. So the 50% rule just basically says you take the high plus the low, you add them together, and you divide by 2. And this is a very natural level for markets to retrace to. As I said just a moment ago, Flibber brought this back to my attention. This was the life work of a gentleman by the name of William Gann, and he developed what are known as Gann angles, and all sorts of derivations off of this concept of the 50% rule, and then applying that concept to increments of time. So as the time component either gets squeezed or stretched, the Gann angle principle presents itself. But the long and short of it is it's based on just the simple notion that markets like to retrace 50% of their previous move. So in this example that I just have on the screen here, our high was 10 and our low was 2. We just add them together, comes to 12, and divide by 2, and that equals 6. And this is a very, very handy, simple tool that you can quickly gauge any market's 50% level, just sort of that natural retracement level. Should a market get overextended, it's a very handy little tool to use to judge where sort of that natural retracement level is. Now, how do we use this principle in actual trading? And this is the 50% down. You could also argue that you can have a 50% up. So in the bull scenario, the high is 10, the low is 2, add them together is 12, divided by 2, it equals 6. Just nice and simple. So I was giving a tutorial a week or two ago to a gentleman, and I just happened to notice that because he was interested in Bitcoin, so we pulled up the chart and we looked at it together. And this is fascinating me because you can see what happened afterward, but frankly we don't really care what happened afterward. What we saw was that the market was up here at what is that high, 539, and it came down to a low of 445ish, somewhere in that neighborhood, 446, 446. Looks like 446 or somewhere in there was our low. Is that right? Where's our low? 446. All right. So, if you just look at these levels, thinking about the 50% level, and constantly thinking about the fact that you really don't want to take trades where the risk on the trade is equal to or greater than the potential reward. So, I'm a fan of the double bottoms, and so you could argue that the market was here, we came down to here, a 50% level of this would be here, but there's no double bottom to play that, nothing set up. We had a potential one here, double bottom, but price tried to get up and break out, but it couldn't. Market price came down even further. This range is getting stretched. Market came down quite a bit, and based on the 50% level, now this is starting to represent a nice distance away from where current price is, but you notice that the double bottom that came in was very wide. So at this point, the double bottom risk was actually greater than the potential reward of a move back to the 50% level. Had you been nice and patient and waited, well, now price made a new low. It rallied back. It came back down and tested these lows, and gee whiz, we have another double bottom. Only this time, the double bottom's risk, and in this case it was like $15, it actually was half of the potential reward had you held on to this position, buying it at the breakout of this double bottom. The reward was twice that of the risk, playing it back to the 50% level. So in essence, this is a valid 50% rule trade setup. Very similar to the crude oil trade, wherever the heck it is. There it is. When the market actually sets up the trade where I have at least a 2-to-1 risk reward setup, it's not so much, debating whether to do the trade. Because at this point, I should not be at the point where I'm like humming and hawing about my trade setup, right? I should have 100% confidence in my trading system and have 100% confidence that when these situations present themselves, I know that I have a pretty good odd chance of getting more in reward than what my risk is on the trade. So in essence, I just got to go and pull the trigger. I see 2-to-1 risk reward setup. I know the 50% level. I know double bottoms, double tops. I got to go. And sure enough, this basically worked out. And the interesting thing is, had you gotten greedy after this 2-to-1, you would have gotten screwed, right? You would have gotten your fill up here. You had another chance to get a fill. And all of a sudden, oh, look, you got another chance to get a fill. And then kaboom. So they say the bulls make money and the bears make money, but those that are greedy and piggy, the pigs, they get slaughtered. So, all right, so that outlines basically the two trading setups that I like to use. I've given you a direct example of the bot in action. You're more than welcome at any given point in time. This is a working example, and I can post this in the lounge here of the bot in action with all nodes, all levels, where to move stops. Again, predicated on what happened prior to set up the trade. If you can learn, if you can prosper, if you can take advantage of this information, I use this model on a daily basis to make money in the market. There's no reason why you can't too. All right, so according to my little presentation material, what did I do with that? I was going to finish off with, we talked a bit about the bot, we've talked a bit about the 50% level, and I'm going to finish up my part of the presentation today, and I know we're kind of running out of time here, LowPro.
No, run it. Here, I'm going to be right back. Check on the baby.
All right. Every week, I follow about 40 different commodity markets, because I just like to know what's going on in the world. And I have been running these models now for, gee whiz, I guess the past 5 or 6 years. So, I don't mean to be cocky, but I think I've gotten pretty good at it. You can go to my webpage, click on the trading forum, go to most recent weekly commodity trend survey. And every week, as I said, I look at every single basically major market. There's about 40 different commodity markets. So that's like all the currencies, U.S. interest rates, all the major world stock indexes, the metals, the energies, the softs, the grains, and the meats. And you'll notice that every single one of these is basically either an AB equals CD price pattern, or it's a 50% level notation. And every single one of them is based off of the simple principles that I've outlined today. And basically, my view as to what the current trend direction is, where the most recent double top or double bottom entry level is, how long the trend has been going on, where appropriate stops are, targets based on bull ABCDs or bear ABCDs, and 50% levels. And every week, if you just pop in, you can basically get a running total of exactly how markets are looking. I thought it was interesting this week, the new trends that we have establishing. I have one that's establishing in live cattle. And if you're a cattle trader, I think that makes sense. I have another one. We won't get into the cattle trade today, but I have another one here in the Nikkei. And this Nikkei looks very, very interesting to me. Because, of course, we all remember that the Nikkei was the market that started this bull run back here, right? And what I see, if we just use our simple harmonic price patterns, hopefully you should see that we have A, B, C with a potential D down in sort of the 12,000 area. Additionally, if we do a 50% level, and that's basically the notation that I've made here, the high 16,450, we'll zoom this in for you here. So on the Nikkei, the high 16,450 added to that 82.10 low, so that's 1650 up here, 82.10 down here, might even be lower than that, but I think that's the low. Yeah, I mean, basically it's this range here. A 50% retracement of that is 12,330. So I might argue, indeed, the trend is actually just broken down. The trend is 1 week old, where your setup, you actually have a 1,000 point risk setup, shorting 1410, long stop 1530, and a reward of just about 2,000 points, or basically about a 2-to-1 risk reward. And all that is saying is, I'm willing to risk here for the potential of the market to come back down into here. This is a bear ABCD target. We have a key low there back, what's this date? This is the key low from June 2013. What a coincidence. We're heading right into that event again. And a 50% rule of this major swing high to this major swing low takes us right down into this 12,000 area. So put it all together, and I think this Nikkei short trade actually makes sense. I may, over the next week, I'll probably take a look at some options there, see what they look like. Now, if you put this into context and you ask yourself, all right, why is the Nikkei going to come down? Well, of course, we all know the Japanese economy right now internally is horrific. And really the only thing keeping the engine going is external growth. That means exports. So what's the one thing that can kill an export-driven market? If your currency starts going up. And if we look at the Japanese yen, lo and behold, we've, at the same time that the Japanese stock market went zooming higher, it was directly on the heels of their currency going zooming lower. So as their currency was going lower, obviously exporters were making more and more and more and more and more and more money. Now it looks like the yen might be starting to turn, and if it is, then I can understand why Japanese companies are being discounted, because if their currency starts going back up, then that cuts directly into their bottom line, which cuts into profits, and we all know that stock indexes are basically a proxy for stock profits. Profits going up, stocks go up. Profits going down, stocks go down.
And I think that's a real easy concept for a lot of Bitcoin traders, as many in the community end up following China exchanges to see especially during certain times and certain incidents, how their own market, say on the European or Western side, is going to react.
Okay. All right. So hopefully what I've done today in today's presentation, last week's presentation, I talked a lot about risk, right? 5% rule, all that kind of fun stuff. Today, I wanted you to see how I actually use trade setups in the marketplace that meet that rule number one of CRI's two rules of investing. And yet, they consistently set me up for having at least 2-to-1 risk reward ratio, and I have a whole bunch of internal rules that make me, protect my butt, stop to break even, then stop to trailing to start locking in profits. And that's basically how I trade, So that's kind of why I wanted to do that angle today. And then the last thing I wanted to touch on was, like I've been, I trade and watch the entire universe of commodities, and I use both of these tools that I've demonstrated today on a daily basis on every single market that I follow. And just for example, that bull ABCD pattern that I demonstrated on a 3-minute chart in crude oil is exactly the same price pattern that we see on a weekly crude oil chart, where here is A, B, C, D. Here are all the bought levels. Basically exactly the same management, but this is on a weekly basis. All right, so it's now about 6:30. I've talked a heck of a lot. Hopefully I've covered all of the points that I wanted to cover in my presentation today. Where's
Oh,
my...
I gotta
Now,
add
your
to
turn, sir.
now I gotta
Uh,
add to something that you were talking about on the on the measured moves and the AB equals CD setups, and how perfectly it worked for this crash coming that just happened in Bitcoin. And let me set my screen share here. Okay, can you guys see my screen? There we go. All right, now I've set this up, pulled it up from Bitfinex, and what you typically would have seen with the price action, and this is actually what I was expecting right here, over here, this bluish trend is from the 440 level going down to the 400 level, and then rebounding another $20, and then crashing down and bottoming out around the 380. And we still had a AB equals CD action to it. The big difference being the thing that changed the price with the setup is that you had that humongous crash and sell right through 400 and all the way down to 380. And you'll notice with the original setup, you had a $40 down tick and a $20 uptick and a $40 down tick. But look what's happened. You set this up and you had 440 to 380. You had a $60 downtick, a $20 uptick, and then another equal measured $60 downtick to the bottom to 340. And then perfectly after that bottoming out, you had the exact same thing on the bullish side. You had that run up to what was it, that 410 level, and then back down to closer to 380, and then back up for another measured move throughout that time frame. So which as you guys will recognize, is that reverse head and shoulders pattern playing perfectly out in that scenario. And I think I think Magnus called that as it was happening. But before we even had a bottom, I think he was posting charts saying, "Oh, this is going to be a reverse head and shoulders." Am I right, Magnus? I swear it was you who was posting those. But yeah, end up coming out perfectly like that. And you notice, I mean, you had that $400 support and resistance line that had gotten snapped, and where it was previously support turned resistance. And you could have even told, if you didn't have that set up already pre-planned, you could have already noticed that after crashing down with that heavy volume to 380 and that rise up to back to 400 and that failure right there, that should have been boom, that big red flag that we were going to have another measured move downward just like that. And then you also notice that that resistance, that 400 level coming back into play after the rally as well, perfectly lining up. So yeah, and any thoughts, Brian? I got a +1.
Well, it all sounds good.
But
I'm gonna put my headset on. I apologize if it's gonna be messy. Sorry. Um, what I would say is that you'll often find that continuation patterns make up components of larger patterns. So your bearish ABCDs, and then conversely your bullish ABCDs, they end up making up a bigger inverted head and shoulders pattern. That's and it all sort of fits together. And the thing is in hindsight, you look back on it and go, oh yeah, look at that, it's so obvious. But when you're right in the moment, it doesn't seem. I mean, I've been studying this forever, like that Gartley pattern that I showed you on the crude oil.
mm-hmm.
I mean, what's fascinating is you get to a point where you go, I've seen this before. I know exactly what's going to happen.
mm-hmm.
It's remarkable, and I love the fact that I'm at this stage, where you actually can literally sit there and go, yep, it's going to stall. There it is. It's stalled. Now, the question is, do you take the setup? That is part of your trading plan.
Mm-hmm.
But just being aware, and, like you said, Magnus and you were joking about, yep, here comes the inverted. Yep, I can see it. There it is. Yep, there it is. Yep, and there it is. Yeah, and there it goes.
Well, and then, like I said, I mean, only alteration to having that set up, if you were planning that down, say you missed out on the short from 440, and you were looking to cash in on a shorting position, or if you were looking to catch that $20 uptick, that original pattern would have worked perfectly, um, especially considering that 400 level right here was strong support. And I mean, there was. I mean, if you were watching the price action at the time, the order book on the bid side was just thick. But of course, nobody expected somebody with an incredibly large amount to run that support, boom, instantly. And of course, as soon as that happened, the price targets at that point changed just a little bit lower, especially after only making it to 400 versus the 420, which it would originally been at had that guy not stepped into the market and ran that support so soon. So, but yeah, that's just kind of touching back on to what you were talking about. Now, over what I was going to go over was basically the common mistakes a lot of traders make, and I know some of it is basic, but at the same time, even the veteran guys, the guys that have been doing it for 20, 25 years, even the guys that have made their whole life careers over it. These are some of the things that you can have all the experience in the world, and you still fail at because, well, we're human beings. We're going to revert. The reason we have these principles, these rules, these setups, is because the market itself is based on human emotion, and that's what ends up getting us in the end. And that's why I always have listed on a sticky note on my on my screen the 90-90-90 rule. 90% of traders lose 90% of their money in the first 90 days, um, because it's those adherence to the principles. And I'm just going to go over some of the common mistakes. I've got some of it written out here if you guys can see my screen. Just a quick overview. One of the big ones that I know Brian is definitely a big supporter of is the not having a plan or not having set up, not doing a research or analysis to come to a firm conclusion right out in the first place. I got a quote from Martin Taylor. If you don't understand why you're in a trade, you won't understand when it is the right time to sell, which means you will only sell when the price action scares you. And most of the time, when the price action scares you, it's a buying opportunity, not a sell indicator. Martin Taylor. So, any points to that, Brian?
I've
Anything
got
you
an
want to add?
awesome analogy. I mean,
Sure.
this is what kills me about these bitcoins, right? And a lot of people watching this are relatively new. But I've been running these tutorials now for a few weeks. And one of the tutorials I did, we just looked at the daily Bitcoin chart. And see if I can just pull it up here. And I tried to convey the idea of the OTE levels in this institutions, but the problem is that if you're just listening to me for the first time, then you're like, oh yeah, sure, Brian, yeah, sure, yeah, sure, yeah, sure. So we went through this whole tutorial, and I talked about how institutions wouldn't buy an up market, that they wanted to wait for the market to come back to the OTE, this zone. And that the sweet spot just so happens to be right in the midpoint. That's an area that I like. And then we looked at the price action around that OTE level, which happened to be 375 area, 375.94. And we noticed that there was some key lows around there too. So this gentleman and I basically, and he had basically come to the conclusion on his own that he was going to buy at 380, and that he was going to wait. And it was really interesting to watch as sort of the debate raged in this area about whether this was a bottom, and certain people were picking bottoms, and this is it, and it's never going lower, and yada yada yada. And this gentleman just kept saying, well, I'm going to buy at 380. I'm going to buy at 380. I'm going to buy at 380. And I was very proud of him, because we did our research, and it looked to me like a half-decent level to take a shot at. So we had the meltdown, and I talked to him, and I said, oh, great, so it looks like you should have been filled. You should be an owner now. And he said, oh, no, Brian, I pulled the order. And this is after the market had bounced back above $400. And so I was like, oh, no, why did you do that? And, just as you were just mentioning that, Landon, that quote of that gentleman, that, and this is why I developed this Willie indicator to begin with, is that when you get these, stupid markets and price action just acting just stupid for no other word, that seems to be the best word I can possibly think of, that elicits a fear reaction in us humans, and ironically enough, those are buying opportunities. And, I'm not saying that he would have flipped it right out, but just in the next day or two, a 380 long was looking brilliant. And it still doesn't look too bad here. But it's just an excellent sort of follow-up to the quote that you had from that gentleman, basically saying that, when you're acting on emotion, you're actually not doing the right thing. And if you have a plan, you have a reason why you want to take a trade, don't let emotion get in the way of screwing up your trading plan. And it does. And
Oh yeah.
all traders fight with it.
Well, at the same time, not even on the exit side, but the initial entry side. If you're not trading with a plan in the first place, then then I mean you're far more likely to be wrong right off the get-go. And then even if you are right, you're likely not to profit from it. So it's
Right.
just it
So,
hits
and
you in both directions.
speaking to your trading over this past week, and I
You,
have heard it from a few other people, that when you don't have these rules of why it is you're actually going to do a trade, unless you can recite them in your sleep, with one hand tied behind your back, you really ought to do yourself a favor and write the rules down. Why is it I'm going
Mhm.
to take a trade? What are the specific criteria? What minimum risk reward do I have to see on a setup for me to justify taking the trade? I would argue that a 380 long or whatever, if you follow your 5% rule, um, uh, maybe you risk half of that capital, but your reward is a test of the old high, so you're going to get like a three times your return.
Mhm.
Some sort of trading plan along those lines. Um, and I guess the sad part about it is I often see people say they will do something, but when push comes to shove, they end up talking themselves out of it, just because they don't have a really concrete trading plan. And I myself have been fallen into that trap with these bitcoins because I've been, thanks to you generous people and my sort of request to get a Bitcoin fund up and running, I have like a fraction of one Bitcoin right now. And because I'm not using leverage, it's only 1 to 1. I'm not really strictly adhering to a trading plan, because if you've got like a half a coin, $100 move is like $50. It's not really that big of a deal to you at the end of the day. Whereas I do follow my trading plan on crude oil, because I actually make, I try to make a living off of that. Like I want to make like hundreds of dollars on a daily basis. And so I'm a far stricter when it comes to following the plan when I'm actually day trading a commodity. I suppose if I was using like a super leveraged instrument to trade these bitcoins, I would have to stick to a more strict trading plan.
Mhm.
But I don't. I really appreciate the community's input and my help to get this little Bitcoin fund up and running. But until I get up to at least, I'd say 2 or 3 coins, it doesn't make a lot of sense for a guy like me to be in there trying to clip for $20, $30.
Although
You end
even with
up actually losing sleep over it.
even with two or three, I mean you can trade on 2.5 margin and make some decent trades with that. You know.
Hey, there's a send. I haven't seen you in a while. Sorry, I didn't mean to interrupt there.
Oh
Yeah,
yeah.
so long and short of it here is I have not been following a trading plan very closely on the Bitcoin, and my Bitcoin trading, I'm 100% long. I am technically bag holding this whole way down. It's been a fascinating experience. I literally cannot take that kind of chance trading crude oil on a daily basis for profit.
Yeah.
I can't take that kind of chance.
Well,
What's
speak.
up, guys?
Hey,
Super
Matt.
glad that I got a link in my mailbox there to.
Oh, good. You actually did get a link, eh?
Yep. So hey,
Yeah, so
John.
we've got about 10 minutes left of this 2-hour session, Ascend, so good timing.
All right. Well, after it ends,
Oh, geez, I'm gonna have
after
to
it
go.
ends, whoever still wants to hang out, we can.
I'm
I'm.
just playing with you. I'm just playing.
Oh, geez, 10 minutes. I'm gonna have to go through this quick. All right.
Oh, you still got a lot of stuff, and it
I got
doesn't
a
have
ton
to
of
end
stuff.
right at 7. So I talked a little bit too long, so I'm going to
Let's.
shut up now and let's get Landon. I want to hear the rest of your presentation. So I'm going to go on mute.
Well,
The stage is yours.
oh no. You don't have to go on mute, but let's just run through this
Quit
real quick.
asking for my feedback.
Yeah. Well, no, that's good. Another common mistake is falling in love with your stock, commodity, security, or Bitcoin. You gotta remain impartial to be able to trade successfully. Anytime you start to have a bias, and even on the sell side, but anytime you start to have a bias in which way you want it to go, and typically if you like something really well, let's say you're a big fan of Facebook, and you want their stock to go to the moon, or most commonly here Bitcoin, and you want Bitcoin to succeed really well, and you want to see the 2000s and the 3000s, and just having that initially set up in your mind is going to deter you away from being able to be impartial and make good trades on the way down. There's a lot of people that have had that mindset for the last 6 months and have been being burned because of it. Which also, where is it at?
Fibber. Fibber.
No, he's been trading it a lot. He's let's see. Yeah, where? Okay, anyway. Uh, but also, another big common mistake, not being patient. I correlate trading a lot to fishing. You got to take your time, be patient. Sometimes it could take all day for you to catch a big fish. Got to know which ones to throw back and so forth. And really, there's no point in getting mad at the fish if you don't catch anything. So, Jesse Livermore's quote was saying, "Don't give me timing, give me time." That's because within the trading atmosphere, as long as you're patient, the good trades are going to come to you. And this is not a sprint. This is not a race. This is quite literally a game in which the tortoise does beat the hare every single time. The more wildly you trade, the bigger risks that you take. The more likely that you're going to take a big hit that you can't recover from. Let's see. Also, within that, and also the trading side, is knowing when to tinker with a setup and when to leave it alone. I think Brian touched on some of that a little bit earlier. Also, and that also touches into another big mistake: looking for what you want rather than a confirmation. If you're catching yourself wanting an outcome on a smaller basis rather than searching for what is right, then you're already fighting an uphill battle. Or another big thing is anticipating profits in a particular move. Instead, I mean, for me, I'm always looking for different reasons why something might break my plan or break the structure of how I saw things setting out, and then I actually write them down, just to make a mental note of is this a good reason to change and alter. Also, another big common mistake is trading too big for your gut, and the common expression is to trade with only what you can afford to lose, and I change that more to trading too big for your gut, because if you don't, you will exit out of fear more often than not, because even not because your plan was proven incorrect, but because the fear itself will get you when you're trading with so much that you can't handle, and sometimes it takes a little while to build up a tolerance to that, and of course. A lot of that saying is going back to investing and trading more than you can stand to lose for your lifestyle, but it also ties really well into your individual trades, I believe, as well. So define an amount that you can afford to lose, a price level at which your plan will be invalidated based on that data, and come with the right position size for you. I mean, for me, I can quite literally trade 100% at 2.5 margin on a consistent basis without it affecting me. And when it does start affecting me, if it's gotten too hot in the kitchen for me, I leave. I step out, go take a walk, get out of there. But it's usually not the volume amount for me. Now, if I started trading back and forth with 100 grand, I might, if I had 100 grand roll to play with here in Bitcoin, at that point, I know, especially for now and my emotional stability, what I can handle at this moment. I know that would be far too much. So I would have to trade probably with a good 25% back and forth, and in very very rare circumstances, trading with anything more than that. Also, big one I always talk about, and love any extra input you can put into this, Brian. But averaging down on trading, you know, it it's a okay strategy if you're investing, but definitely on the trading side, never average down a loser. In trading, you have to be able to admit when you're wrong, and if you take an action that goes against you, and then you were wrong, for the same reason. And the most important thing is to figure out what that reason was, so you know what your next move will be. If the best move, if you got yourself into a losing position, the next move might be the best to hold on to it. The next move might be best to kill it, and you've got to figure out why you're losing that position first before you start backing off of that. And at the same time, it also puts you in a mindset to where you're always seeing basically a longer term outcome. I know everybody with Bitcoin sees the long term trend. We've all seen the continuation charts over the long term time frame. But even with as bullish as Bitcoin is over the long term, on a trading and investing level, that is something that you absolutely cannot, for 100%, be sure that that's going to happen. There can be, at any point in time, other fundamental factors that can come into the market and affect you. That's why institutional investors, a lot of the big money, uh, will wait after the correction, like Brian was talking about, and start moving in closer to these range levels after that despair phase. Because even at that point, that could still turn into a losing trade over the long term, but their losses are are much much less than had they just said, okay, well, we're just going to take a guess. We'll start buying here at 900, and then work our way down to 800, and then 700, and then 600, and then 500, and then 400. And you can see how this builds up and builds up and builds up until you have an incredibly toxic portfolio on your hands. And then you're at that point at the mercy of that next price movement that you're predicting, which, if it doesn't turn out, then you just have to eat it. It also makes you lazy because if you're already anticipating that, if you're averaging down that position, then you're not really looking very hard into what the correct position is to get in and get out of at any particular time. Also, of course, a very, very well said common mistake is any action based on emotion. A big one for a lot of people is, as Brian mentioned, FOLO, fear of losing out, and panic buying in a situation without having it planned out. And then on the flip side, fear of losing entirely, and having fear gets the best of you, and then closing out a good position ahead of time. And also, a big no-no is not keeping track of your trades and not being introspective. How would you ever be able to basically tighten down the hatches, be able to refine what you do, why you do things, and also, of course, the biggest factor being discipline. How will you ever be able to ratchet down your discipline and what you do and how you do it if you don't keep track of that time frame, of those actions over a long period of time? I mean, I've made so many trades just within starting this trading experience within the first 6 months, that I mean, there's no way to keep track of them all. what you learned, what you lost from it, what your progress was over an extended period of time. If your winners are bigger than your losers, if your average is consistently growing, if you're taking too big of risk, or if you're taking not enough risk, and so forth. So and that just allows you to not only be introspective with yourself and your own discipline, but also refine down your own techniques and what you need to enhance. And I'll finish it out with anybody just starting out. Never should expect to make money with this. I know. When I started, and I'm sure will continue to, and I know it's the same thing for Brian or any professional trader, is paid with their education, with their losses. So never get too discouraged with even if you take a big loss. We talked to a guy earlier this week that was in a short position from, what was it? I think it was Flipper was talking about him, or we had him in the me and Flipper had him in the chat. It was like I think it was like 360. He shorted at 360. Yeah. So and for some reason it ended up closing his position way up here too. So a huge loss on that side. But that's like I've just said. It's one of those things that you don't learn from your wins in this game. You learn from your losses, and if especially if you're not keeping track of it, if you're not paying attention to why you won, why you lost, then you're never going to be able to progress in this very, very, very long game that continues out quite possibly until you want to retire someday. So anyway, that is it for me. You there, Brian?
Yeah, great stuff as always. And actually, I really like the word presentation. Just it helps to be able to see stuff in writing. So thank you for doing that. I guess we're basically at 7 o'clock now. So I'll just quickly review any questions that I see in the lounge. Probably
Brian,
best if you
I did have a question if I could butt in there.
To type it up, so then that way I can read them off. And then maybe we'll just open it up to some Q&A. So I see Eric B. wrote earlier, I understand the 5% rule with gambling. However, with BTC, does that mean I should sell 90% of my Bitcoins and keep 5% for trading? Or does it mean I should trade with 5% and keep the rest of my Bitcoins in cold storage? It's like a catch-22. So I guess, for me, when I read that, the question I would have is, and, this is really getting to sort of more financial planning, is, what does this stack of Bitcoins actually represent as an overall percentage of your overall assets and income stream? So those are questions that need to be answered in themselves. Like the guys in Vegas, if they figure their stake, right, that's their working capital, right? That's their working money. So, if all of these Bitcoins represent all of your working money, then really, it's really a function of 5% of that overall stake. How you use that stake is up to you. Like I said, for Mr. Long-Term Investor, risking 50% of the capital of a purchase is probably an okay idea. When I do a lot of options trades, that's often a rule of thumb, is you just risk 50% of the option principal. Now, if you had $100,000 worth of Bitcoins and that was your stake, you got nothing else, Does it make sense to risk 50,000 of those dollars on one trade? I don't think it does. Now having said that, you could put the whole 100,000 in or leverage it up, but your risk or your stop on that position would be whatever 5% represents. So, a lot of the really strict money managers, they want to use an even smaller number. They go like 2%. Now that's really free willing. The bottom line here is that for every trade that you're considering doing, there really should be an uncle point where you just say, you know what, if it hits this level, I'm wrong. And then really the math should take care of itself. If you look at your entry point and you realize that the exit point, or the point where you have to admit that you're just wrong, if that's just too far away, then you have to have the professional kahunas to just say, I can't take the setup. It's just too risky. So, the 5% rule it can be implemented a number of different ways, but I've heard Landon basically say, if a position starts to move against me, I'm already starting to figure out how do I get out. And then when I really pressed him, well, would you actually risk 5% of your stake on this actual, like, for instance, that at that point it was a short? And he's like, no way, I wouldn't risk that much money. So he already has built-in ways to try and make sure that he doesn't breach that 5% level. And then really, a second part to that is, are you actually trading this huge chunk of coins that you have? There are participants in these groups that have big chunks of coins, and yeah, they are. They're going 100% in and 100% out. If you're finding that you're only trading like a quarter or a half of them, then my hunch is that you're really best not to keep all of the coins at one of these exchanges, and that's just purely a function of risk. They actually say in the market there's two types of risk. There's systemic risk and unsystemic risk, and that's just that is just speaking to systemic risk. And we've got this wonderful example of Mount Gox as our example of systemic risk that you have absolutely no way of being able to factor into the equation. So, hopefully that helps you, Eric. It's kind of a lengthy answer, I know, but what the hell?
To explain the high volume side for me, because I know I and Flipper are one of them. But for me, the big reason why I trade so much back and forth is solely because of me tracking my progress and knowing my average, and knowing what I make consistently over gains, and knowing my win to loss ratio both on individual trades, whether they're right or not, profitable or not, and also the ratio to profit or loss. So as long as that stays consistent over a steady amount of time, I mean, for me, there's no reason other than the emotional factor for me not to go 100% full margin every time.
Yeah, but that's one trading strategy. The question is, when the trade goes against you, how do you handle the situation? And
Same way I would if it was a smaller amount.
Well, all I'm saying is, at some point, everybody has an uncle point, and just try to make sure that uncle point is no more than 5% of your overall stake. If you stick to those guidelines, the statistics are on your side. It's kind of like the idea of, is it easier for a sailboat to sail into the wind or to sail downwind, right? I mean, the obvious answer is to sail downwind, right? So that's all I'm saying, and that's, it's easier said than done, because I think, Landon, you may have gotten into that kind of situation over this past week.
Mm-hmm.
And when push comes to shove, how do you act? And that's kind of why I like stops, because they don't give you a choice. The stop's in there, your level's hit, boom, you're out, and you got egg on your face. Yeah, I'm not batting 1,000%, so I'm not perfect, damn. But you're forced to just move on to the next trade. That's why I personally like stops.
So, Brian, if I may ask you, I want to get down into the details. Say you have a position that's going against you, and you have one at, say, 360, and you have one at, say, 380, and all of a sudden the market just takes off like a rocket ship. And what do I do? Do I close the 380 with the market execute, or do I close the 360? Because that 360 is
Well,
just going to
I
turn
mean,
into big numbers.
yeah, I mean, you're talking about short positions?
Yeah, and
Right. So then you have to ask yourself, if anything, the answer has already been the answer is already there, right? But the real answer you're not going to like to hear, right? I mean, the very simple answer is that you should actually know where I was wrong,
yeah,
I have to get out. You already know that level before you ever put the trade on to begin with. And if you don't know that level, then you haven't done enough homework.
yeah,
And I actually don't think I don't believe in setting stops based on a percentage myself.
I don't
I
necessarily say a percentage. What
yeah.
what I say is, like this is why I like to use the bull A B C D patterns, right? So if my premise is correct that the AB equals CD pattern is indeed playing itself out, then by definition my pullback point, or I have my tick just one tick below my stop one tick either above or below that point C, whatever it is. Um, I'm basically saying that if this AB equals CD pattern is correct, then I'm going with the trade. If this harmonic pattern isn't present, then the C point will be broken and I'm out of the trade. So already ahead of time, I already have all the requirements, everything's already been predetermined, and it makes my life so much easier. The problem with what they call discretionary trading is that really it's left up to you. Now, I know a lot of professional traders that hate stops, that say, I'll use quote unquote mental stops. But the question at the end of the day is, will you actually obey that original stop point if it's not forced upon you, where a physical stop in the marketplace is? Now, I see stops get run all the time and it pisses me off, but really, Andre, trying to get back to your the point, the question is, if you look at your model, was that sell at 360, was it actually a good trade idea? Would it have met, if that exact same setup had happened another 19 times, would you have gotten the positive results that you were looking for, more than 14, 15 times over the next 19 times? Or would you actually find that if you did that trade model again another 19 times, 14 or 15 of them would have done exactly the same thing that just happened? You know what I mean? So I'm a bit concerned that the reasons for putting the trade on to begin with in the first place were not really technically sound and didn't set up a 2-to-1, at least a 2-to-1 risk-reward ratio at that given point in time. So,
Which is easy to do when market's crashing and emotions are flying high.
yeah, but the
and you
sad
tell
part
me, yeah,
about it, right, is that people, ironically enough, in the stock market, you have to be buying when others are selling and selling when others are buying. But the human emotion is to get fed up into that selling euphoria. And I've done that trade tons and tons and tons of times, where you're so wrapped up and you got, oh yeah, it's making new lows, it's breaking to new lows, so technically I got to go short. But then you don't put the actual move into context and realize, wow, we've already come from this far, far, far distance. Does it really make sense going short again and looking for more on the trade? So it sounds to me, and then Andre, did you, after the first initial 360 short didn't work, did you add to the short? Did you throw that 380 on afterward, thinking, well, if I wanted to sell 360, 380 is even better, so hit it again? Is that what happened?
Yeah, this is a sin, but it wasn't quite that bad. It was a little
What
bit
did
of
I
a
say?
hypothetical, but I'll tell you what, it was similar to that in the fact that, I was buying a large percentage of the way down, and I'm like, oh gosh, this is going to go further down. So I'm kind of trying to close out those buys for a little bit of a loss and open up some shorts. And what happens, right?
So,
So my question is how do you strategically manage? I want to kind of pinpoint what you said, and I think you oversimplified it with the fact of you just close your position out. Well, which positions do we close out first? The ones that are nearby, or that $60 one that's painful right now, but it's going to turn into a $300 one. You know,
that's the irony in it all is I've had as a broker I've had this conversation at least a dozen different times, and it's never it's actually statistically um, actually, again, the statistical odds of me giving you an answer that will work and that is beneficial to you and that everybody comes out looking good are actually against me. Yeah, like if someone was a betting man, because if I tell you to sell and it goes up, then I look like an idiot. If I tell you to sell and it goes sideways, well then, no big deal. If I tell you to sell and it goes down, well, then you say, yeah, well, thanks, Brian. So actually, statistically, the odds are heavily against me. Now, I think I understand what you're saying. You've got to manage this loss. And so I guess, looking at it from an accounting perspective, I like the idea of just closing out the loss with the least amount of pain. So if you're just down a little bit on the 380 short, then whatever the level is that you can comfortably get out at least on the accounting ledger, when you look back over time, you're not going to have multiple nightmares. You're just going to have this one nightmare trade. I really, if the 380 short came on after the 360 short, then that to me is the talking about adding to losers, and I really don't like averaging into losing positions. So that was kind of a boo-boo there. And really, I guess the way I look at it is, I guess if it's a really sizable position, you could always there are some third-party vendors that are floating options now, so you could consider about just buying a call that at least it will give a finite risk amount to what it is you're actually risking here. So you could maybe buy some out of the money calls, so to hedge your position that way, at least you know what exactly it is that you're risking managing this short position. That's something to consider. So those would be two ideas that I would throw at you.
well, Brian, I think that's a great idea, especially with hitting such a massive low here. That would have been a great position to take on as a long, right around that 350. But hindsight
Well,
is
yeah, I mean,
2020.
hell, we all look brilliant if we could pick the bottoms. I just, for like long-term investors, I think that I also just talking about these bitcoins, I find it very interesting how the sort of chat velocity, if you will, has really slowed down. And I love to watch these things as sort of third-party perspective. And around Christmas time, things were really hopping. And it slowed appreciably. It's at the same time, we're just now coming into that zone where institutions would actually seriously consider buying. So it's just you literally, you could write a novel on how this is played out because it's so cliche, and all of the cues, all of the reasons. I mean, the irony of all of this is that this whole Mount Gox scenario, and now this Chinese. I mean, I find it hilarious the language that they use. Or if I understand correctly, there isn't actually a quota. It's just Big Brother just wants to know that you're buying these things. I don't know, crazy language. But anyway, the point of the matter here is that none of this is actually affecting the actual fundamentals of the Bitcoin concept itself. And so, this all seems like fluff to me. And really, it's just a question of, it almost feels like they're just engineering the market lower so that the institutions can buy into this silly optimal trade entry window. And here we are. And I find it hilarious that people are so filled with panic, and yet this is exactly what markets do. Fascinating to watch.
Absolutely. And did you hear the news actually out today? There was an institution that already has $100,000 of Bitcoin, and that, relatively small amount, but I'll tell you what, they're buying right now.
Oh yeah, I would. The sad part about it is I wouldn't be surprised if they did some accumulating on that. What I noticed is that, if you're a large institution and you want to take a big position, the only way you can really get filled is when you create these panic nightmare sell-offs, right? And you get these huge volume bars. Like the Bitcoin itself. This is the daily chart. The only way you can get filled in size is on these really big down panic spikes. So, if you're a major institution and you want to buy, what are these bars anyways? This is only 43,000. I mean, hell, that's not a heck of a lot, right? But say you wanted to buy 10,000 of these coins, you actually engineer these sell-offs. And Andre the other day, Flibber, he was talking about how, and I think it makes a lot of sense to me, the only way you can get filled on 10, 20,000 coin orders is if you engineer a sell-off and a panic. And Flibber was basically showing how there was a guy who was sitting there offering 30 to 50 coins and just working the market down. So maybe he gets filled on 2,000 total coins on his way down. If he knows that the market's going down, he can always buy those back into this orgy of selling. And of course, Mr. Big Shot, who wanted to get his fill of 10,000 coins, this is the only way he's going to get it, is when you get this mass panic dump, So it's fascinating to watch the whole thing play out. It's absolutely incredible.
Andre wrote on here, $40 million were bought across all exchanges post-crash. $40 million worth of Bitcoin.
Wow. Oh, wow.
Yeah.
And that would explain, I'm sitting here listening on the computer, and just these alarms are going off that I have, and it's the sell alarms. But at the same time, the price is relatively stable. So what we have is the retail people freaking out and selling, and the smart money just sitting there and buying it all up, right?
That's the way it always happens.
Now, the smart money, they've got deep pockets, right? So, just as Andre Christaki, I hope I pronounced your last name there correctly, as he posted, my bottom of my OTE zone is down here at 293. So, just because we're in the zone, and yes, they are buying, this sort of milieu, where we play with this lower end of the channel here, this could go on for a couple months. I'm certainly not saying that, this is the bottom. But if you are an investor, this is the area I think that you can start taking realistic investment shots at this thing.
Yeah. Anybody that would start averaging down would start averaging down right about here.
I love that 375 level. I could see, the interesting thing is that big OTE there was 375. So now if we start looking at, okay, what's the range here? Gee whiz, look at the OTE. In fact, I've already done it. So now we're going to get this massive higher frame OTE. And now the lower time frame, look how close they're going to be now. So they're setting this thing up so that they get another buying opportunity down at this higher time frame OTE level. Here's that higher time frame. The sweet spot's right here. So, typical knee-jerk reaction. This is so normal for markets, right? They always overshoot. So then it bounced back, and look at this. A natural correction is going to take us right back into that 375 area.
Hey,
Tough
hey,
place to go.
I got something you'll like us in because I normally play like I was telling Brian earlier. I normally play crashes really well, and this one threw me off guard because like I had mentioned the standard A B C D pattern, and it initially threw me off because I had shorted it at 460, and I closed it at 440 just to get some sleep because it dragged on and on and on and on and on, and I'm so used to the fast price action of Bitcoin that I was starting to get nervous, so I closed it. Well, of course, I wake up in the morning and the whole thing had crashed down and missed out on an incredible win. So much profits, especially I was short the whole roll on the thing. But it was kind of funny how the price action went. Because here's the crash from then, and you were talking about some of the things that you were seeing as it was all actively happening, and one of the things I had on is and I ended up getting in at about 406, and I mean that it looks like a pretty good spot. MACD was starting to turn over, start to look a little bullish. It fit into a measured rebound after such a big sell-off. So I was predicting a rebound upward to 420. In fact, I had a sell for my long position just under 420. So I was going to bank on a good $15 profit there, and we can see what happened here. It just missed my spots. And it's like, okay, well, it's still got a little room to go. I mean, we gotta see some bullish action in here sometime. And what had happened, of course, boom, is that happened.
Let me see. Explain it.
Yeah, that 800 or 8,000 coin sell that had just ripped through 400.
Oh wow, I see it.
Yeah, we had tanked right through all of this support, and I was expecting us like the whole move to be like this at 180, and ending there, but it ended up, yeah, I ended up having to of course close my position at a loss, and at here for some reason, well, I had closed the position and it had tanked down, and for some reason I ended up starting to buy around the 180 level, acting like it instead of it being a measured move, it was a double bottom because oh my gosh, nobody's gonna, nobody sells that much. Everybody's gonna, buy up against that. Well, that didn't happen, and I ended up closing it and rebuying at the 170 level, which then I had to close and cover. Which ended up, of course, going down all the way to 340. And I think me and a few other guys ended up getting in that 350 range. But since I hadn't stuck to my original trade plan, I'd been thrown off emotionally, starting out here and then thrown off emotionally again when this asshole ended up tanking the market. So I was in a horrible position to be trading at that point, and I was still breaking even back and forth with my trades. Big thing that happened, and I at that point won it back. But after all that emotional turmoil, I should have obviously seen this as another measured move back up. In fact, Magnus I had been posting those head and shoulders patterns. It made perfect sense. And for some reason, and mostly for the fact that I was so traumatized from alt price action before and not sticking to my plan and being emotional, I got out at 375. And that happened.
Exactly. So, and you can hear the emotion in your voice, and no one's blaming you because we've all been there, and it's common to go there. So I was just thinking, with these big, dramatic, intense moves, I almost want to hand it off to the computer because I think that it could, do more of a logical, calculation here than taking a little bit of the emotion out, and then I'll take back over the wheel, on some of the slower trading. But it seems like
It's
with
actually the
all the
opposite.
emotion, yeah, it just messes me up with all the FUD.
Yeah, it's
I
actually
would,
the opposite.
I
Bots
would,
do better in a ranging market.
I'd say that yeah, during these violent swings, if there's enough volatility, that algo trading should really do well, right? You know, uh, just your simple little moving average that I guess we see on Landon's screen here. That's just a simple little buy signal there, and it's translated into some pretty good money. So I can understand how algo trading would do well through this. And like my example of Mr. 380, I find it fascinating that the algos themselves, like if you just ascend, I don't know whether you can or not, but if you could just set up a nice simple algo that buys and sells 61.8 fib tags, I've been noticing that they're just money, absolutely beautiful to watch. And yet the irony of it all, like if you can see my screen here, um, look at that 61.8 tag there. It's perfect. And the market just stopped on a dime. Just absolutely just stopped on a dime.
So, CR, that's what we need to do. We need to, with all the Forex programming and everything for MetaTrader, there's got to be something out there that would just kind of point that out, like beyond a shadow of a doubt. Because not always do I have the fibs exactly on base, and I know that there's many that share that same concern.
Yeah, that's the danger, right? That's kind of like the Elliott wave theory and all that, right? Is the danger ultimately is this is all left open to interpretation, and so it's tough to leave it in a computer's hands to interpret things. You know what I mean? Having
Absolutely.
said, pardon me?
Absolutely. You just want a little bit of more feedback. I feel like my computer could be doing a little bit more for me.
Well, I like if we just looked at my screen right there, right? I mean, I can see two very simple little. In fact, I can see three very simple little. I can see four. Very simple. I can see five. Holy crap, this is crazy. I can see five very simple little tools that you could have your computer sort of sounding alarm bells off of, just off of my little chart that I see here, that all told you that a 61.8 tag there was probably a pretty good short. And it turns out that so far that short is working quite nicely. The issue that I think here is people get very obsessed with the the absolute low or the absolute high of a move, and they focus on that number. I would argue that at the end of our last cryptocurrency show on Wednesday, everybody left the show feeling very bearish. We even got Flibber to the point of very reluctantly placing bids below the market, not saying he wanted to even own the market where the current price was. So there was lots and lots of anecdotal evidence that this market was ripe to roll over. So it was at that point that the algos and stuff should have been flashing the sell signals. And if you just look back on my chart, and I don't mean to toot my own horn or anything, but the last cycle, it's the same nonsense. Here was the OTE zone. Here was the 61.8 tag. So there was lots of evidence that you wanted to be short, and sure enough, this end part here is not what we should be focusing on. The place you should have been focusing your attention, and you should have been asking yourself, is why didn't I short this OTE short spot? I mean, this is where we had this initial big down move. This is where the institutions were going to justifiably short this thing, and sure enough, they did. Flibber told us anecdotally of stories that he thinks people were actually like being paid to sit on the market and drive it down, because the smart money knew something like this was going to happen.
Oh, wow.
So I guess the way I look at it is, here we are again, nice technical bounce, not a big surprise. Now, it'd be interesting, here we are at this trend channel, so it'd be interesting to, get anecdotal evidence of this, Flibber see people sitting on the market, how are the bids and offers being worked, but, just based on, fib analysis alone, it shouldn't surprise us if price gets up into here that, people are going to start hitting the market again.
So, Brian, I think a lot of people did just that. They shorted it right there, but like Landon said, we didn't hold the shorts, and if we did, we'd be doubled up in pretty good shape.
Yeah,
I finally got my short in right at fourth, good short position right at 439. So I'm finally sitting good.
But hey, remember like a week and a half, 2 weeks ago, we were talking about those shorts from 520, 505. Those would have been juicy.
Oh yeah.
So I mean, how do you keep that patience?
Oh, I did that twice.
Yeah.
And that speaks to your trading plan. I mean, Ascend, do you have a trading plan?
Oh no, don't be too hard on me. It is Saturday night.
So, it sounds to me like we got a bit of an answer there.
So, I mean, you got a trading plan. It's as many monitors as possible and watching every single market move. So.
That's not a trading plan. That's a man cave. What I mean by trading plan, right?
Well, babysitting price action is a good way to get you in trouble too. Unless you're actively trading just the 10-point swings, it can get you burned more often than not.
Yeah, because keep in mind the market is designed to feed into our human emotions, right? So like that, the market is actually designed to get us to do things that are not in our best interest. So, how's that trading plan? And then, in the trading plan, theoretically, all of your trades should have their targets already determined before you even put on the trade. So, just as you know exactly how much you're going to risk before you put on the trade, I think you should know exactly what your target is. That's why I use AOCO orders, which are auto order cancels order, and they just sit on my DOM. When I enter in an AOCO order, the stop order and the exit order get entered at the same time. And the last point I'll make on that is that the guy that I was listening to Friday, Dr. Andrew Menaker, very, very smart market psychiatrist, was talking to us at Top Step on Friday, and he actually went on YouTube and he taught himself how to play guitar, specifically when he was in trades.
Wow. It makes sense a lot.
He actually made it a plan where he said, when I am in trades, I have to put the, because, if the orders are all in ahead of time, then, all the work is done. And I have to go and do something that's completely different. and he went and taught himself how to play guitar. I love that story.
Everyone that's involved in this market needs to be exposed to that concept and that idea because I think it's so healthy.
Well, absolutely, and you know that we have just a simple saying: "Hey, set it and forget it."
Oh man, but no one ever does, man. You
Well,
always
I
kind of
have
keep it
to.
here.
That's the only way I was funded. It's the only way I was funded. You know, and the worst part about it, the irony of it all is what you guys are saying here. Every single trader goes through exactly the same thing. It's not like, and it's so funny because we hear the same crap day in day out from our trading coaches and stuff, right? And every single person that types in the chat, "Oh, I thought he was talking about me. Oh, I thought he was talking about me." I mean, we're all humans. We all do the same things. That's the irony of it all.
Well, and give it a week and a half, 2 weeks, and you'll fall back into your bad habits. So you got to kind of pound that in. So that's why the show like
You
this is
have
so
to get.
important.
This is what they call, another speaker that we have. His name's Ray Burchett, and Beauty. He's familiar with him. I don't know where she is these days, but anyway, and his course is called Intuitive Development.
I
So
like that.
the way I interpret that is we as traders have to get to the point where all of that stuff that you just talked about there, Andre, like all of this stuff about trading plans, all of this stuff about risk management, all of this stuff actually becomes intuitive because you already know it. It's kind of like, would you ask Pat Sajak how to go and run a Wheel of Fortune show? He could probably do it in his sleep, right? He's done it so many times. He knows intuitively exactly what the next thing to do is. Would you ask, when Michael Jordan was at his peak, would you even question Michael Jordan dribbling a basketball and slam dunking? He could have probably done it in his sleep. It's you have to get to the point where, and it kind of concerns me that you guys aren't even at the point of building trading plans, but you have to get to the point where when somebody asks you your trading plan, you could literally say it in your sleep. You know what I mean? And once you're at that point, then you can start acting intuitively in the market where you just know what your setups are. And I've sort of reached that level with my bot, is that I know what my trading plan is. I'm comfortable with the risk levels. I understand the exit strategy. And so when the market presents it, I go. And that's a hard place to get to.
Just knowing where the market presents, because it's so elusive sometimes. But the whole time you were thinking of that, I was mainly being the technology guy that I am. I'm thinking about how I can pimp out the MetaTrader to help remind me, be an extension of myself. Maybe move that stop loss up a little bit, draw some of those Fibonacci's in an estimated area, and just give me more indications. Right now, it's just such a dumb thing.
Well, the sad thing is, and I think I've said this before, right? Indicators are lagging by definition.
Right, but not just indicators. I just got the Willy there. That's all I need. But more than that, because too much of the indicator is just insane.
Well, and so the question really is I don't understand why you're not using more of the OTEs, right? Like a guy like you should know exactly where institutions are going to be buying and where institutions are going to be selling. So I'm a little surprised. Do you follow the concept of trend versus range? Because you should have basically two different strategies, right? A ranging market, you have one strategy. A trending market, you have another, right? The indicators themselves will act differently during different market states. So, there's a bunch of stuff that you can work on. I would start with, I'm sure your MetaTrader somehow can draw fibs off of just significant highs and lows, and basically have little alarms that when you enter in an OTE zone, at the very least, if you're entering in an OTE short zone, I have a little indicator that says don't buy. Right?
Exactly, man. I'm thinking of this, like the OTE panel where it just gives me a couple different variables right there. And you look at those before you make your
Well, so I really
risk.
like the idea. See, I could really see this higher weekly OTE, right? So if you had a nice little matrix and
Perfect,
you
yeah.
had, pardon me?
Yeah, that's perfect. Go ahead.
So if you had a matrix that had weekly OTE, daily OTE, 60-minute OTE, and if you get a market that goes into the weekly long OTE zone, and then the daily, it consolidates in that OTE zone that sets up another OTE, right? And then in the hourly, you have a consolidation that sets up another OTE long. If you had
Three
like
greens.
3 greens all in a row, that would be just a kick-ass long trade. And you
Yep.
could run that matrix right across the stock market. And I was talking about my little option strategy recently, and if you look at it, let's see if I can pull it up here for you. One of the stocks is basically doing exactly that right now. And it's really interesting to watch the reaction. So we had this, this longer term pullback, right? And then back into the OTE. So on the daily, back into the OTE, and then on the hourly into the OTE. So it just kept coiling, right? And then, so this is the OTE zone right in here, right? If I just do a quick fib here, I think this is the way. Nope. Yeah, this is the way. Right, so this level here is the OTE of this, right? Boom, right there. So, you as a technician, all right, I'm going to be watching this level. Then you had another one where it came down back into this OTE. Then you had a little bit of a rally, and you had a little bit of an OTE set up here. There. So now the OTE is there, just off of this little move. So you get these layers of OTE action here, right? And it just keeps setting up. And then what's really interesting, if you can zoom in on this even more, if you look even closer, I mean, it just, it gets a little bit silly after a while. But, you could easily draw a MetaTrader, algo to hunt for these things. But keep in mind, this is all the OTE. Lots of buy, 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 buy. And then you get another little OTE just even here, right in here. So you get all of these OTEs layered over one and over, layered, 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 layered. This is a pretty damn strong level in here, this $2.50, $2.60. Does that make sense, Andre?
Yeah, hey, yeah, it does. It's a send. But if you had Willie in
Oh,
there,
did I do that again?
yeah,
Yep,
no,
it's easy.
I
We got
call
like
everybody on.
two or three
Everybody's
Andres
on
in
there.
here.
And sure enough, look how 250 acted as a level, and then vroom, took off away from there. Right?
So that's three greens, and then if we had Willie on there for the fourth light,
Well, Willie
I really just
himself,
look at the
right?
dashboard. Yeah.
Here's Willie. Willie went stupid oversold here, right down in this area. Now, a lot of people will say, I don't want to catch a falling knife, right? Have you ever heard that term? So the great part about this OTE concept, right, is that, all right, wait for the counter trend rally, and there it is. And now, if you can get a pullback into the OTE of this range, then that's a buy signal, right? And then the market bounced off that OTE, and then it gave you another pullback into another OTE. At that point, Willie's already gone, right? Willie's like, see ya, I'm out of here. You could also throw in I'm a huge fan of the bullish momentum divergences, right? So here's a nice bullish momentum divergence right there. So you have, where did that come from? I guess here. Lower lows, and yet on the momentum, we had higher lows. So, there's lots of yummy stuff in here. You got a nice little double bottom on Willie himself right here, right? So, the momentum indicators are saying, yeah, looking good. And, volume was no screaming hell in here, right? That's the catch a falling knife kind of thing. Because it's in divergence that, yeah, we're somewhere near a bottom. Then all the multiple OTEs layered on said this 250 level is solid. And look, then you get your OBV turn, and of course Willie not even near overbought, so you can, quite often the 50 line itself on the Williams percentage R, this is a really good level to work with. So we got a nice bottom off of there, and it broke through there, which actually in itself, this market transitioned from bearish underneath 50 to bullish plus 50. That's another way of using Willie that we haven't even talked about.
Speaking of Willie, on that last crash, on the one day, it was the first time on the Bitcoin charts that Willie ever touched negative 99.999.
Is
Yeah,
that the moving average or the actual indicator?
that was the actual indicator.
Oh, yeah, that makes sense. Well, and
it was buried there for a good $30.
Yeah, well, and so the question is, what did the higher time frame say? Because if I remember correctly, the 4 hour, it just had a nice slow slope downward to it.
Yeah.
All right, guys. Well, it's now 10 to 8, so we've gone slightly over the 7 o'clock time slots. I think I'm going to wrap up the YouTube show now. You guys are more than welcome to stick around for further chat. So to that end, this has been CRInvestor. Oop, that's Fibber. That's a different one. Which show has it been? Where
So, Brian, you're just going to close the YouTube stream, not the window, right?
Yeah, and we're just going to have fun in here for a while. Do whatever. Let the madness happen.
All right, so thank you very much for everybody attending. Thank you very much, Landon. Did you enjoy yourself tonight, Landon?
Oh yeah. This has been fun, and
I think we're getting
fast paced than than the last two.
Yeah. Slow and steady wins a race. We had a nice conversation to begin the night, and kind of like we thought, people slowly trickle in over time, and I can see that seats filled up as we went along. Hopefully you enjoyed my presentation on the basically two trading models that I like, the bot and the 50% level, and how I am a stickler towards making sure that my reward is at least, if not more than my risk, and how that's a mantra in my trading. Talked a little bit about CRI's weekly commodity trend survey, so feel free to check in on that if you want to see the bot in action, the bull ABCDs in action across the entire globe and all the 40 commodity markets that I follow. Thank you very much, Landon, for your presentation on sort of trading mistakes, what we can often try and avoid doing. Of course, easier said than done.
As always.
Again, I hope people take to heart the two rules that I've found myself have kept me out of a lot of trouble and made sure that I stayed liquid and funded through all this time working with this proprietary firm that I work with in Chicago. They really do work. You just have to take this professionally. I hope you all had a good evening. Thank you very much to everybody who attended in our lounge. Golf club. I hope everybody that has watched this on YouTube has enjoyed themselves. If you have any questions, feel free to get a hold of me. My website itself, I don't know if you can see that screen or not. Yep, is therationalinvestor.ca. I can also be reached on Twitter at CRInvestor. And you can click on my website. You can, as it's shown there, have a calendar of all the upcoming shows, so you can see exactly when and where you can get a hold of us. Landon, I suppose people can get a hold of you. LowPro, is it at LowPro? I don't know how it works. LowPro at TradingView. Do you have a Twitter address?
No, I don't. Just my Google Plus and Trading View for right
All
now.
right. So,
I'm thinking about setting some stuff up though,
right.
just for fun
So,
in the near future.
in the near future, I'm going to hold you to that. So, as you can see on my website, you're more than welcome to go to these YouTube channels that we have here, including the second selection, Cry's YouTube shows. You can see all the back episodes of Landon and our fun adventure, working our way through these Google Hangouts. Look forward to seeing everybody this time next week. Hopefully, maybe a little homework assignment. Everybody in the lounge, you need to put together a 3-point trading plan that outlines why you would actually take a trade. So that's your homework. I'll hold you all to that if you're going to attend next Saturday's show. Other than that, all the best to you and your families. God bless. Thank you very much for the opportunity to talk to you all. You have a great trading week, Landon. Fingers crossed you get back on track with your trading plan, and all the best to everybody. Good night.
You too.